Hello, everybody, and welcome to my Wiley solution walkthrough. This is for tools for business decision making, 8th edition, exercise 20-5. Textbook authors are Paul Kimmel, Jerry Weingart, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so we're going to go ahead and approach. We've got our question right over here. So we've got Pottery Ranch has been manufacturing its own finials. I don't know. The company is currently operating at 100% of capacity, and variable manufacturing overhead is charged to production at a rate of 70% of direct labor cost. The direct materials and direct labor cost per unit to make a pair of finials are $4 and $5 respectively. Normal production is 30,000 curtain rods per year. A supplier offers to make a pair of finials at a price of $12.95 per unit. If Pottery Ranch accepts the supplier's offers, all the variable manufacturing costs will be eliminated, but the $45,000 of fixed manufacturing overhead currently being charged will have to be absorbed by other products. Okay. So should we, when they say incremental analysis, the way you want to look at this is that you want to say, okay, what is it going to cost me if I continue to go through and produce it as is? What is it going to go through and cost me if I decide to outsource it? So if I continue to go through and produce this particular product as is, what am I going to have to spend? Well, I'm going to have direct materials. I'm going to have direct labor. I'm going to have variable factory overhead, and I'm going to have fixed factory overhead. If we look at this on a per unit basis, my direct materials over here are going to be $4. Direct labor is going to be $5. For the variable overhead, it's charged at a rate of 70%, right? So this is 5 times, which is the direct labor, times 70%, okay? My fixed factory overhead is at 45,000. But if I'm going through and producing 30,000 units on a per unit basis, this is going to be about $1.50. So this is 45,000 divided by 30,000. Okay, so in terms of going through and producing this, so current production, right over here, the cost per unit is at $14 per. However, so this is going to be our total current production. However, when we go through and look at this, right, if we look at, and if I were to do this, put this in absolute dollars, what would this look like? Well, if the per units are here, my units are 30,000. My total cost right over here is going to be 4 times 30 or 120. 150, 105, 45, or a total over here of 420,000. We love that number. Okay, so this is the current production. If I went and outsourced it, right, what would that look like? So if I outsource my per unit, basically my purchase price is going to be $12.95. However, if I go through and if I do 30,000, total cost over here is going to be 388,500. However, that is not the only cost that is involved here, right? And why is that? Because it tells us right over here is that a supplier offers to make a pair of finials at a price of $12.95 each. So this is going to cost us $388,500. But if Pottery Ranch accepts the offer, all variable costs will be eliminated, right? What's variable? Right over here. Direct materials, variable. Direct labor, variable. Variable factory overhead, that's variable. Okay, but fixed factory overhead will not be. Okay, so over here, this fixed factory overhead is still, whether I produce units or not, I'm still going to have to go through and absorb this $45,000. So over here, my total cost is really going to be at $433,500. So if I look at it this way, right, it's going to cost me $433,500. This is about, how much higher is it than my current production cost? Roughly about $13,500. So again, this is something to consider. You also have to consider too, is that if you eliminate a product, you're also putting people out of work that are going to be in your local area. But at the same time, though, is having employees expensive? And the answer is absolutely yes. So you really have to kind of go through and do that cost benefit analysis. So when we look at this from a big picture perspective in terms of like this first scenario, you know, should I go through and buy the millennials? I don't know. The answer would be no, right? Because my actual current cost now is $420, and the outsource cost is going to be $433,500. Now, would my answer be different if the productive capacity released by not making the finials could be used to produce income of $20,000? That now gets us to a different result. Because if I come down over here, right, and for part C, this over here is part B. Okay. Okay. So we're not going to buy this from an outside supplier. But if I come down over here and look at this now, well, is this the scenario? Well, what we're going to have happen is my fixed factory overhead is still going to have to be absorbed, right? So we're not really getting rid of the fixed factory overhead. However, I am going to be saving myself. It's going to be used to produce income. So this is effectively, I'm going to get a $20,000 cost savings. So this is now going to be looking like more of, oh, this is now going to be costing me $413,000. So my production savings of $20,000. So this is now putting me in a better position. So let's go through and read this. So would your answer be different if the production capacity released by not making the finials could be used to produce income of $20,000? Well, if this is going to be freeing up existing production, then you have to take that into account when you're going through and doing it. And when we look at it here, that's now at a $6,500 savings. So by having the freed up production, and again, why am I showing this as a negative? Because it's giving us over here, it's going to be producing income, right? So these are costs that I'm going to be unable to absorb. So I'm basically subtracting that, because if I'm able to produce income, I'm going to be getting these back. These are really costs or expenses, cost of goods sold, or, you know, other overhead expenses. So in this situation, by getting that extra additional production capacity, I'm basically now at a position where it's $6,500 better. So one thing I am going to show you when I go through and do these questions, and I've kind of done this on other questions over here, and I just want to show you kind of, I'm just doing these questions like a little bit differently than the way that your textbook is going to have you answer these questions. You know, so over here, you know, so if I don't like using this opportunity cost, or excuse me, right over here. If I make or buy, like this is pretty similar to what we have over here. Like if I buy it, I still have the manufacturing costs, the purchase price over here. So we're kind of coming up with the same one. This one, I don't like it though. And the reason is because I don't like this notion of opportunity cost. It messes me up. What I like to do is to say, okay, we're coming to the same answer. It's just a different way. But what I like to always do is to kind of say, okay, I'm basically, if I do this one, I'm saving 20 grand, or I'm going to free up production. So we're coming up with the same answer, is just a little bit differently. So in any event, I want to thank you again, thank Wiley for allowing me to make these presentations. If you have any questions, feel free to ask in the comments below. Don't forget to like and subscribe. And if you'd like to see other solutions, please feel free to ask for them in the comments. Have a great day.